Tesla's recent financial report presented a curious puzzle for investors to solve. On the surface, the initial numbers appeared to signal a positive turn. The electric vehicle giant announced that its total revenue for Q3 2025 had indeed grown. This development was noteworthy because it broke a pattern of decline seen in the previous 2 quarters. After a half-year of contracting sales figures, a return to growth should have been a clear cause for celebration. Many expected the market to react with enthusiasm, pushing the stock higher. Instead, the opposite occurred in the hours following the announcement. The immediate reaction in the stock market was not one of relief or optimism. Instead, Tesla's share price began to fall, creating a stark paradox that left many casual observers scratching their heads. How could a company report higher sales, snapping a negative trend, and yet see its market value decline? This question highlights a fundamental lesson in stock market analysis. The headline revenue number is only one small part of a much larger and more complicated story. Investors are trained to look far beyond that single figure. They dig deeper into the report, searching for clues about the company's underlying health. To understand the market's reaction, we must first look at the specific figures from the third quarter of 2025 report. As mentioned, the top-line number, total revenue, showed an increase compared to the same period last year. According to the report cited by CNBC, this growth was driven by a modest uptick in vehicle deliveries, Tesla's energy division solar panels, battery storage products. Seeing the company successfully sell more cars and energy solutions is, in isolation, a positive sign. It demonstrates that demand for its core products remains present in the market. This is the good news part of the earnings release, the figure that initially seems encouraging. However, the story changes dramatically as we move down the income statement from revenue to profit. While more money was coming in, the company was keeping less of it. The key metric here is profit margin, which measures how much profit is generated for every dollar of sales. For Tesla, this number was under significant pressure. The report revealed that the company's automotive gross margin had shrunk once again. This figure is watched with hawk-like intensity by analysts. This indicates that the cost of producing and selling each car is taking up a larger percentage of the sale price, leaving less room for profit. This trend is a major red flag for investors who prioritize profitability. The decline in margins directly impacted the bottom-line earnings. Earnings per share, or earnings per share, is a critical figure. It represents the company's total profit divided by the number of outstanding shares. For the third quarter, Tesla's earnings per share did not meet the consensus estimate among Wall Street analysts. When a company misses its earnings target, it often triggers an immediate negative reaction from the market. This earnings miss suggests that the company's operational efficiency or pricing power is weaker than anticipated. For investors, a miss on earnings per share is a much more direct and concerning signal about financial health than a beat on revenue, as profit is ultimately what drives long-term value. This contrast between revenue and profit is the central theme of the third quarter report. One of the primary reasons for investor anxiety was the direct and visible strategy of price cuts. Over the past year, Tesla has aggressively lowered the prices of its popular models in key markets around the world, North America, Europe, China. This strategy has a clear and simple goal: to stimulate demand and maintain market share in an increasingly competitive environment. By making its vehicles more affordable, Tesla can attract a wider base of customers who may have been priced out before. The higher delivery numbers in the third quarter report show that to some extent, this strategy is working to move inventory. However, these price cuts come with a direct and unavoidable consequence. That consequence is the erosion of profit margins, a point that cannot be overstated. When the price of a car is reduced by several $1,000s, but the cost to build that car remains relatively stable, the profit made on each unit sold shrinks. Investors have long prized Tesla for its historically high margins, which were once the envy of the automotive industry. These healthy margins suggested a strong brand, superior technology, efficient manufacturing. The recent trend of declining margins, however, suggests that this competitive advantage is weakening. Investors worry that Tesla is being forced to compete on price, behaving more like a traditional automaker than a high-growth tech company. Compounding this worry was the company's guidance for the future. An earnings report is not just about past performance, it is also a crucial opportunity for company leadership to set expectations for the upcoming quarter and the full year. In its third quarter of 2025 report, Tesla provided guidance that many in the market interpreted as cautious or even weak. The company signaled potential challenges ahead, refraining from the bold, ambitious growth targets that have historically energized its investor base. When a company lowers its own expectations for future growth, it serves as a powerful signal to investors, prompting many to sell their shares. Finally, the combination of these factors, price cuts leading to lower margins and cautious guidance, creates a troubling narrative for those focused on future earnings. For example, if a bakery owner tells you she sold more bread last month but had to lower the price of each loaf to do it, you might be concerned. If she then adds that she expects to sell even fewer loaves next month due to rising flour costs, you would become even more worried about the health of her business. This is precisely the logic investors applied to Tesla. The current quarter's results showed that growth came at the expense of profit, and the company's own forecast suggested that the headwinds were likely to continue. The disconnect between rising revenue and a falling stock price is where the real story begins, and this time, the details mattered more than the headline. Tesla's performance cannot be analyzed in a bubble. It must be viewed within the broader context of the global automotive market. One of the most significant changes in recent years has been the explosion of competition in the electric vehicle space. For a long time, Tesla enjoyed a near monopoly on desirable, long-range EVs. Today, the landscape is completely different. Legacy automakers like Ford, General Motors, Volkswagen have invested billions to launch their own compelling electric models. New, EV-focused companies are emerging as formidable rivals. Consumers have more choices than ever, forcing all companies, including Tesla, to fight harder for every sale. The competitive pressure is particularly acute in China, the world's largest and most important market for electric vehicles. In China, Tesla faces fast-moving domestic manufacturers, BYD, NIO, XPeng. These local competitors can offer advanced vehicles at significantly lower price points, directly challenging Tesla's market share. The third quarter report contained mixed signals about Tesla's standing in China. Any perceived weakness or loss of momentum there is a major concern for investors. Beyond direct competition, Tesla is contending with macroeconomic headwinds affecting the whole industry. Central banks around the world have raised interest rates to combat inflation. Higher interest rates make car loans more expensive. Buyers who could afford payments 2 years ago may now find them a stretch. Many will delay purchases or opt for cheaper cars, dampening demand. This cooling demand hits all automakers, but is tougher for companies priced for rapid growth. These external factors create a difficult operating environment. Think of it as a talented sailor navigating a powerful ship. For years, the sailor had strong tailwinds and open seas. Now the sailor faces headwinds, choppy waters, a fleet of other ships competing on the same route. Even with skill and a great ship, the journey will be slower and harder. This is Tesla's situation, a strong company in a much tougher external environment, and its financials are beginning to reflect that reality, making investors nervous about the journey ahead. In summary, the story of Tesla's stock falling after its third quarter 2025 earnings report is a classic case of investor expectations outweighing a positive headline. The company reversed a 2-quarter trend of falling revenue, but that single data point was quickly overshadowed by a host of underlying concerns. The growth in sales came from aggressive price cuts. Those price cuts directly squeezed the company's once enviable profit margins. That decline in profitability showed up as an earnings per share figure that missed forecasts, and guidance did little to inspire confidence.